Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Michael Ewald, Partner and Global Head of Private Credit at Bain Capital. Mike, it's a pleasure to meet you virtually. Thank you for taking the time. I'm looking forward to our conversation.
Sure, Todd. Happy to do it. Glad to be with you today.
So maybe just to kick off, it's been a pretty up and down and volatile year, in the market. I'm curious, has that changed the competitive dynamic within, the private credit space, and kind of how has the market played out year to date?
Yeah, look, I think volatile is certainly a good word for it. The first quarter was actually pretty busy with the new administration here in the U.S. A lot of euphoria around pro-business ideas, things like that, and there's a lot of that tariff and related back and forth certainly dominated headlines a bit for the second quarter. So things definitely slowed down. Although here in the third quarter, we've really seen deal volumes pick up again. There have also been some broader economic considerations, though. I'll throw out the continued threats to inflation, some weakening signs in what has hitherto been a pretty firm labor market, and so there's just a really uncertain environment right now. So you really do have to be choosy, despite volumes kind of going up and down a little bit. And what you have seen, though, is continued strength in the fundraising market itself. There's certainly been continued interest in the asset class. There's even a new executive order out, which may increase further retail demand in alternatives, including private credit. But from a competitive dynamic, I think one of the nice things the last 3 to 6 months is we've seen more of a bifurcation, really, between the quality of deals earlier this year when it was so busy in the first quarter. Before the muddied economic outlook, it was really hyper competed. There's a little more discipline in the market today, at least in our core segment. There's a little more differentiation between what is actually a good deal and should get best in class terms, and what is maybe a more mediocre deal. Nothing wrong with mediocrity, in this sense, right? But there's been a little more clarity, I think, and a little bit more credit underwriting in the last couple of months.
And is that generated more deal activity, less deal activity? Kind of what has the, I guess, overall acceleration or deceleration of deal activity looked like?
Yeah, it's really, again, picked up post some of that initial tariff uncertainty. There's a little bit of whipsawing back and forth. I mean, certainly you've seen continued strength in the equity markets, right? So if you're a seller in today's market, you're thinking, geez, I can really get a pretty nice price for my asset. So that has contributed to, over the last couple of months, 3 months here, a lot more acceleration in deal volume for sure.
And when it comes to specific sectors, what has proven to be most resilient in the current climate?
Yeah, I'd give you a couple examples here. I'd say services broadly. There's financial services like wealth management. They've been pretty strong. Insurance brokerage, for example, as well. Then there's business services. If you can make it cheaper, easier, faster, quicker, more efficient for a company to operate, I think that's always going to be, in vogue for sure. Healthcare, I would say, is newly interesting, at least to us. Certainly the talk's always it's defensive, it's resilient, it's recession resistant, but there was this whole grouping of physician practice management, or PPM, roll-ups that was happening a few years ago that have found tougher times, I think, of late. Once those have worked through, those weren't the best deals. We actually avoided a number of those. There's some interesting trends now around some specialty areas like behavioral health treatment that are particularly strong. And then I'll throw a bit of a curveball out at you too. Aerospace and defense, that's always been a specialty of ours. We continue to like some of the longer term trends in commercial aerospace, and I'll say there's no slowdown in need for defense these days, right? So we're continuing.
Even it seems like Europe is even picking up some of the
Yeah, it's picking up some of the
the
slack there
spending
for
there.
sure. 100%.
Um, and then, when thinking about kind of the underwriting new deals today, I mean, how do you think about, there's been many who believe that we're heading up into a recession. There's been some indicators maybe that will be or not. I mean, how do you assess that when thinking about underwriting new deals in this market?
Yeah, look, a great question. Remember back in was it the end of 2023, beginning of 2024, there was this alleged recession that was constantly 6 months out, but it was perennially 6 months out, right? So every quarter it got shifted out another 6 months.
Yeah.
And back then, I'd say a recession case was almost like our base case from an underwriting model perspective. I wouldn't say it's that bad again yet, but we're getting close to that level now, where certainly our base case is nowhere near what a management team might be presenting to us, during the first go around.
What does your remit at Bain look like today? What does Bain look like today? And then, kind of where is the sweet spot that you guys focus on in the market?
Sure. Look, I mean, Bain's probably best known for its private equity business. That was the original business going back to 1984. It's still our largest business today. It represents about 75 billion or so of our 185 billion of AUM. But credit at about close to 55 billion at this point is really the second largest and arguably the fastest growing segment within Bain Capital. And then the private credit group I lead is really approaching $20 billion of AUM now. It's historically been mainly direct lending, both on the senior side, the junior side as well, which a lot of people forget about, sponsored and unsponsored. Geographically, we invest in the US, we invest in Europe, and in Asia Pacific, although it's really primarily Australia, New Zealand to date. And then we've dabbled, for lack of a better word, in some asset-backed finance, and we're looking to grow a little bit more into performing real estate debt too. So, private credit certainly incorporates a lot more today than it has in the past.
And is it still offering, kind of the most attractive risk-adjusted returns compared to, say, opportunistic or special situations?
Sure. I mean, yeah, it sort of depends on the actual asset class, right? I mean, I would argue that senior direct lending should just be a core allocation of someone's portfolio anyway, right? It shouldn't be particularly volatile, but it could generate some interesting just cash on cash returns. I think in terms of risk adjusted return, where I see some interesting opportunity today, it's probably counterintuitive given some of the economic malaise we just spoke about. But junior capital, I think, is actually particularly attractive right now. Given high base rates, there's not much of a market for traditional mezzanine debt, sub debt, second lien, cash pay type securities. So if you can tolerate the often PIK nature of a holdco security or preferred equity or something like that, you can earn a mid-teens to a high teens return, which historically would come if you were in that 60 to 80% loan to value range. But today you can get in that 40 to 60% loan to value range. And that's why that risk adjusted piece is an important one, because you're that much more senior in the capital structure and still getting a pretty juicy return.
And when it comes to, you mentioned you guys are, doing sponsored and non-sponsored. What does that breakdown look like? Are you seeing deals that are non-sponsored gain more traction, still dominated by sponsored deals?
Yeah, it's again a mix. It's probably still more dominated by sponsored deals. In a sense, it's also easier, I suppose, to go out and source deals from 20, 30, 50 different sponsors than it is directly from, a couple 100,000 companies, right?
Yeah.
So from that standpoint, it's kind of easier, but, even there, you can still work with any intermediaries, debt finance firms, brokers, et cetera, to find some of those more unsponsored deals. On the sponsor side, I think they continue to face pressure from their own LPs, both to realize some of their existing investments, also to deploy newer funds, right? And the common archetype there might be a sponsor to sponsor transaction. It used to be just you would sell a majority, if not all, of the company. Now you might just sell a minority because you're trying to realize some sort of a return,
Yeah.
sooner rather than later. On the non-sponsored side, I think there's there's kind of less pressure from a timing perspective. These are often founder-backed, family-started businesses. They might trade more on a generational shift within that family, and so you don't see that same consistent pressure to try to transact. So the fuse on those deals can be a little bit longer too.
And how do you guys view the growth of private credit more broadly? You have U.S., Europe versus Asia. Obviously, U.S. is still the biggest market, but are you seeing greater growth in Europe, Asia, Middle East? Like, how do you guys look at the global landscape of private credit right now?
Yeah. Well, look, it's interesting. U.S. is certainly the biggest market from a private credit perspective. I would argue Asia has the greatest potential, though, from a size perspective. Could be
Okay.
as big as the U.S. and Europe combined, right? As I mentioned, and as you just reiterated, we're certainly active in all the regions, right? It's been interesting to hear a lot of our peers talk up Europe recently. The U.S. market can be frothy sometimes. We opened our London office there on the credit side back in 2005 and have been active there on a direct lending business or perspective, since then. The key thing to remember about Europe, though, right, is it's a series of different markets. They each have
Yeah.
different nuances. The two things we always focus on are economic stability and lender-friendly legal regimes, which cause you to migrate more northern and western from a performing asset perspective. Asia Pacific more broadly, it's a growth opportunity for us. We've been lending directly in Australia since we opened an office there in 2013. Actually, been active longer than that, but we've had team members on the ground since 2013. We've had a special situations presence actually there since 2014, starting in Hong Kong and now in 10 different offices. So what we're trying to do in Asia now is almost marry that local presence we have across Asia broadly, and then that direct lending know-how we have in Australia to really expand our presence in Asia Pacific more broadly, because we do think that that is where the most opportunity resides today, and also, quite frankly, where it's most underbanked, and we can
Hmm.
provide some more creative financing solutions than local banks can, and there aren't that many other players. In fact, I can't think of any that have had that long-standing a presence there. Certainly, people have moved there more recently, but talk about Europe being different markets and having different nuances. All the more so in Asia, legal regimes, et cetera, are all very distinct and different there. So we think that's a huge opportunity set.
When it comes to newer entrants into private credit, I guess have you seen more newer entrants? I mean, it seems that there's fundraising announcements seemingly every day, and
Mhm.
then has that led to any shifts in pricing or terms? Someone trying to kind of bully their way into the market. I mean, what have you seen when it comes to newer entrants and kind of the impacts that they might or might not have?
Yeah, look, it's a great question, and it's always it's always dynamic, right? There's a lot of shifting of people's presences. So, look, there's certainly been a number of new entrants. By definition, the new entrants tend to be smaller funds. They tend to be targeting more the lower middle market, right? So companies with 10 or $20 million of EBITDA. That's where the count of competitors is the largest. From a dollar perspective, to your point, there's also big fundraising announcements from some of the larger players at the upper end of the middle market. And
Yeah,
so from a dollar perspective, that's where the most competition is. We're a little bit, kind of in that middle there, in that core middle market, companies with 25 to $75 million of EBITDA, where it's not that we have no competition, but the competition's been fairly stable. Occasionally some of the smaller guys will want to participate in a deal, but they're not setting the terms then, so that's not
got it.
necessarily an issue. Occasionally you've got a more upper middle market focused sponsor who has a particular thesis on an industry, finds a smaller deal, and then wants some of the kind of big market terms, right? So that's when it can get competitive. But generally speaking, the competitive dynamic hasn't really shifted too much in that core middle market segment.
What about any shifts in structures or structural innovations that have come to market or that you're starting to see to come to market?
Yeah. Certainly, the interest in that junior capital solution has certainly been more prevalent recently. I think flexibility around cash pay versus PIK pay,
Hmm.
beyond the typical ARR deal where that's more typical, has certainly been a little more front and center. Look, there's a usual pushback on covenants now that there's occasionally a movement that says, okay, I get I'm a small company now, you need to have a covenant, but when my EBITDA gets to X for more than 2, 3, 4 quarters, I want the covenant to drop away. That's fairly innovative as far as innovation goes within the private credit space. Um, there's been some more attempts at dividend recaps by sponsors, again, under the guise of just trying to get capital back to some of their LPs too. But maybe I'll stop there. I don't want to give too much away to sponsors or management teams and give them too many ideas of what they can try to push us on. But I think those are the couple things that that we've seen out in the market.
And when evaluating deals, I mean, what's the balance look like when it comes to, yield and, and credit quality?
Yeah, look, like there's certainly I don't know if it's inverse or a correlated relationship there, but obviously the higher the I guess it's inverse, right? The higher the credit quality, the lower the yield can be. But ultimately, I don't think you can fix a bad credit with pricing or structure. So I think the key here is just to maintain the discipline to just say no. And it can be tough. You kind of get ground down over several rounds of pitching a deal. At some point, you just got to cry uncle, or just really lean in and want to win that asset. But ultimately, that credit decision should be somewhat binary. You either like the deal or you don't. The extra 50 basis points shouldn't make you want to do a deal, if that makes sense.
Got it. And then when it comes to LPs and the allocations they're making to private credit versus other asset classes, I mean, how should they be thinking through private credit versus ABF versus fund finance? I mean, um, what are some of those dynamics at play, and is direct lending still kind of that core piece of the private credit market that they really should take time and invest in?
Yeah, look, I think you described it well, right? It's a journey for a lot of LPs. Some have been allocating to more bread and butter, if you will, direct lending for a while, and they've kind of reached their target. Now they're looking elsewhere. They've moved
Yep.
on to EBF or to infrastructure or some of the more esoteric things like music royalty lending, et cetera, right? So that's certainly one bucket. I'd say there's another bucket of LPs who have been investing in um, more generic private credit maybe for a while and are looking to diversify. So maybe they have a couple of upper middle market players. Now they're looking for some core middle market exposure, maybe even lower middle market exposure, or maybe it's sponsored versus unsponsored. Maybe it's geography. They're moving into Europe or Asia or something, right? So those are a little bit earlier in the journey. And then there's others that actually are still new to the asset class, if you can believe that haven't invested in private credit or direct lending in the past. They haven't had a bucket that's appropriate for it. Or it could be an insurance company who's found, there's actually, there's more use cases for something that is, I don't want to make it sound too boring, but a little more vanilla, right? And so,
Yeah.
direct lending might fill the, might fill that need there, and maybe it's through an innovation like CLO structures or something, right? And so some are still very much in expansion mode there too.
And then when it comes to, you mentioned it at the top, certainly with the administration trying to push more into retail, are you seeing greater demand for, evergreen or open-ended, private credit structures, continuation vehicles? I mean, it seems like there's this growth aspect to the retail investor that people are kind of just getting ready for. And are you seeing that same potential? What are some of the risks there as well?
Sure. So look, the mix is definitely headed more towards evergreen. Um, from an institutional perspective, I think it makes a lot of sense, right? You can mimic the schedule of a closed-ended fund. You can pick and choose, your entry spots and your exit spots potentially. You can be fully invested day one into a diversified portfolio by vintage company, industry, et cetera. from a retail perspective, I think some of those same advantages hold true for an evergreen. I think that the retail can get tricky, right? Because there's the well-worn path of BDCs, both publicly traded and private.
Yep.
We manage one of each. I think there's some great advantages there for a retail investor. And those tend to be more permanent type strategies, right? Which I think makes sense for the underlying asset class because these are not liquid assets, right? And so you have to kind of match assets and liabilities a little bit. There's now been a movement towards something like an interval fund, right? Where you need to have some liquidity that's more daily. Not to say private credit doesn't make sense for that. We're actually, we've launched one with an insurance carrier partner, right? Where that can make sense. You just have to be careful that you match that liquidity profile with your underlying assets. So you can't be 100% private credit, for example.
Yeah.
Right. Now, I think what you're starting to see is some of these funds or even ETFs that have like ultimate liquidity flexibility there, investing in pure play private equity positions. That might be a little bit harder to manage, right? And so I think it's that liquidity issue that's probably the main pitfall that you're asking about there that you really got to manage carefully because that can get you in trouble, especially from a retail perspective where maybe there's a little more momentum swinging back and forth and a little bit more need and requirement for that liquidity than you might find with an institutional investor who's typically investing for a 5, 7, 10-year horizon.
What about the risk side? I mean, if I'm, if I have a 401k, I want some access to private credit. I mean, do I ultimately really know what I'm getting into, and how big of a bar will I have to reach to understand this? I mean, what about some of the risks that might play into less sophisticated investors if they're looking to get access to some of these products?
Yeah, look, I think what's interesting there, if you think about it from a 401k perspective, you already have access to BDCs, both publicly traded and the non-traded ones, right? And so you can get some of that advantage already that way in terms of high income, in terms of these are 40 Act funds, right? So they're very highly regulated by the SEC. There's always a lot of calls for more regulation of these assets. I think what's missed is they're actually already pretty heavily regulated, where we have all kinds of we have an exemptive relief order, for example, from the SEC. All the BDCs do to ensure that we are allocating on a pro rata basis amongst BDCs that are more targeted towards retail, as well as institutional funds that are obviously targeted more towards institutions. So we are actually, in fact, treating a retail investor the same as we are an institutional investor. These BDCs typically have or have to have majority independent board members, right? So this isn't, us trying to somehow look out for ourselves. There's actually some pretty good checks and balances set up in that structure. An interval fund is structured the same way as well. So, it isn't clear to me that there's any obvious signs there of somehow the retail investor is going to get, screwed, for lack of a better word, right? I think it's going to be more towards you as a retail investor need to understand what you own, and it is not a liquid asset. It might provide you liquidity through regular dividends and interest payments and things like that, right? But you shouldn't assume that you can then sell that share or that asset class for cash when you may need the underlying cash.
Is that a bit of a misnomer about the space, that it's, not regulated enough, and there's there's not enough checks and balances in place, where you just ran through a litany of things that need to be done, or boxes that need to be checked, and ultimately the end investor, there are a lot of things in place that protects them, but yet there seemingly is this I guess, for lack of a better term, conversation going on that there's this wheeling and dealing, and these products are not safe.
Yeah, I think that's right. I think it's just a matter of lack of education and awareness, as you pointed out. It's new, right? And I think it's easy to assume something new is dangerous and somehow not appropriate for the average investor. I'm sure the same thing was said about mutual funds when they first launched. I'm sure the same thing was said about spider funds when they were all launched, and their fairly benign, right? Despite the
Yeah.
name Spider. I think it's the newness factor that's really driving a lot of that, where if folks just slow down a little bit and said, well, what are we actually talking about? Okay, these are the types of funds we're talking about. Okay, there are a lot of protections for the retail investor. That makes sense to me. I think they would be much better understood, but I just think it's a lack of appreciation for what the structures actually are.
You know, there's been some of these deals that have happened in the market. Firms buying or taking over other firms, firms combining. Do you see more consolidation coming to the market overall? There's a lot of new managers, but then that doesn't necessarily expand the pie every year, because there are ones that are taken over or joint agreements. What do you think about kind of where the private credit space more broadly is going, and consolidation?
Yeah, it's an interesting question, and certainly when I get a fair amount, that there aren't that many scale pure play players left, right? In terms of
That's true.
private credit players, right? A lot of them are, like in our case, we're affiliated with a much larger alternative asset management firm, and we grew organically within Bain Capital, right? I think for consolidation to happen, the case has to be compelling. There's the usual buy versus build analogy. It's something that we've evaluated ourselves actually when we look to go into more of a traditional asset-backed lending niche, right? So, is there a different geography niche, something else that's unique about somebody you might want to buy? And so we considered buying an asset-backed lender, focused on on inventory and property and things like that, right? So ultimately, we decided to build rather than buy, and hire a team and set them up with computers literally and a lease, and off they went. So there are those examples for sure too, where you're trying to add on some sort of specialty that you don't have in house already. I think where we've seen a lot more activity, quite frankly, and an easier case can be made, is for an insurance company actually to buy an alternative asset manager, especially a private credit manager, because they've just got so much volume of a premium that they got to invest. And
Yeah.
it's a similar exercise for them, right? Do we buy or build? And do we try to hire the team internally? And some people have tried. Some of it's worked out, some of it hasn't worked out, or they've gone out and bought somebody. So I think that's where you'll see more of it. You might occasionally see a pure play private equity player that might be prepping for an IPO, for example, want to expand in the credit space. In that case, they might want to buy a private credit player. Again, there's got to be some sort of trigger there that makes it a unique case. But just consolidation for consolidation's sake, I don't think there's going to be a huge market for that necessarily.
What about the role of banks? There's been, certainly private credit has in many ways replaced an area of the banks
Sure.
that they used to be in, but you're starting to see more tie-ups between private credit firms and banks, kind of more cooperation than, competition. How do you view that? And has some of these agreements shifted, deals or terms in any way?
Yeah, well, I would take one step back there too, Todd, and point out that as much talk as there's been about the banks and quotes having exited the market, what they've done is they've exited the front end of it, in terms of they're not necessarily participating in levered lending anymore.
Yeah.
What they're actually doing is financing a lot of our portfolios on the back end, right? So
Yeah.
if we have a one times levered
Yep.
book, they're the ones actually providing the leverage for it, right? So that's sort of the irony about the whole thing there. But to more directly your question about tie-ups, we have seen banks trying to get more into getting a piece of that value chain, of that lending value chain, by almost renting out their front end or origination capabilities, right? Because they've got all sorts of banking relationships with all these independent firms, middle
Yeah.
market companies, typically lower middle market companies out there. Why not make an introduction to somebody like us who can then lend to them, right? And so that's where some of these tie-ups have happened. We've evaluated a number of those over the past few years. What we've found is they're generally just, again, pitching that origination capability, and they're trying to still maintain that relationship. And so when we go in and lend to a company, we're typically the largest holder of that tranche, and so we're in some sort of control. We're running the management meeting. We have direct access to the management team. If something goes wrong, we're going to want to enforce, right?
Yeah.
In a lot of these relationships, the banks are saying, well, whoa, wait a second. No, we are the conduit to this management team. Any questions you have, ask us, we'll ask them. And if there's any sort of amendment, we'll negotiate it. And our view is we want to be in control of our own destiny. So we haven't gotten comfortable with any of those. And honestly, I don't think you've seen you've seen some noise and some news around some of these JVs being signed, but you haven't seen a lot necessarily come out of those. And for us, it's also not like we're necessarily hurting for deal flow, so it hasn't been a particularly high priority for us.
What about the kind of the future of tradability or liquidity of private credit loans? And I know that's $1 million question essentially, but what are your views on that as we kind of come to closer to the end of our conversation here with a few questions left? I know that's certainly one that's on the minds of a lot of people.
Yeah, look, I could see it at the higher end of the market, in that upper middle market. You typically have 10, 12, 15, 20 holders. And those deals tend to look more, from a documentation perspective, like a broadly syndicated loan. And so there's fewer restrictions around, trading those, and around confidentiality maybe around those as well. In the core middle market, where we are, I don't know how, as a buyer of a loan on a secondary platform, you're going to get enough information to make a decision, because ultimately the company owns that information, and they don't necessarily want to help you with whatever issue you have in terms of trying to sell their loan, right? And so the fundamental flaw in my mind is really twofold. One, the holders of these loans tend to be more of a buy and hold lender, right? We're all much more, in the storage business than the moving business. And so it's not clear to me, why somebody is actually selling. And then given some of those restrictions around confidentiality, trading, et cetera, I mean, the natural buyer for these loans is somebody else that's in the club or the syndicate, right? So I'm not sure you need a market maker. You can make a couple of quiet, discreet calls, and try to place your sale that way, as opposed to announce to a market maker, hey, I'm desperate, I'm trying to sell this thing, what can you get for it? And so given that too, I think there's going to be a pretty wide spread in the or a wide gap in that bid ask spread. So I'm not sure it's ever going to make economic sense either, necessarily.
And final question before our final fun questions and out the door. What about AI? And clearly it's going to have an impact on software businesses that you guys might or might not lend to. But what about, internally, how do you think about the use of AI, for your platform, underwriting, ingesting of data, documentation, reading? I mean, how big of an impact could AI have on your business, and kind of how you potentially evaluate companies?
Sure. Well, and I'm disappointed for a quick second to say it's a lot of it's still TBD, right? We'll have to see how it all works out. But look, we're constantly evaluating how AI can help us become more efficient. I think that's ultimately the name of the game here, right? In fact, one of the partners of the group here, one of his side hustles is basically our guinea pig for new technology and AI tools, to see what he can try to help us be more efficient. So I think from an underwriting process, there are a couple tools that could help work through data rooms, for example, right? Help you summarize a lot of data. Ultimately, doing that more efficiently and saving time allows you and the team to look at more deals, and so that that's an efficiency increase there as well. The other thing we're trying to do is utilize AI to help us glean insights from our existing portfolio company performance. That could influence our underwriting for new deals. We have over 200 companies in our portfolio today, so understanding how correlated performance of some are or is based on industry, based on size, based on something else, might inform how we think about underwriting a new investment. But we certainly don't think AI is in a position yet to actually make investment decisions. Clearly that's what we're being paid to do, and that's certainly something that we're going to continue to keep with the human intelligence for now.
So for some fun questions as we get to wrap up here, favorite sports team and/or hobby?
Look, for sports team, I'd say anything Boston related, and whoever's playing the Yankees or the Jets.
Tell us one surprising thing about yourself.
If I wasn't a private credit practitioner, I'd be a history professor.
Okay. Speaking of history, one book that you'd recommend reading?
Of course, it's going to be a historical book, right? There's one I actually just finished, which I don't remember how I found it because it doesn't have a whole lot of ratings associated with it, but it's a book called The Picnic, and it's a true story of a handful of I guess dissidents, for lack of a better word, who organized a picnic back in the summer of 1989 on the Hungarian border with Austria. And what people may not appreciate is the Iron Wall, or the Iron Curtain, was still up right at the time. And so that was kind of a big deal to be that close to kind of the freedom and the West and all that. And through a confluence of events, the Hungarians were allowed to found ways to avoid the checkpoints and crossed into Austria. And interestingly, they kind of crossed into Austria. They didn't stay there. They kind of came back and told everybody about it. And that then led to a bunch of Hungarians saying, well, geez, I want to actually do that and stay there. And then the East Germans caught wind of that. And then you had this mass migration of East Germans down to Hungary that then snuck out to Austria through kind of this backdoor loophole situation. That's actually what eventually led to the fall of the Berlin Wall, in that fall. And ultimately the destruction of the Iron Curtain, effectively, right? So kind of, it shows the randomness, I think, of history and how, a small innocent group of I guess idealists can just drive and affect pretty tremendous change. So it was just an interesting book for me. And I've got a German background. I actually was living in Germany while this was going on, and so it was fascinating to watch it. Wow. Fascinating to read the story about it after the fact.
Interesting. I'll add that one to my list. Most exciting part of your job?
Look, I'd say interacting with the team. We've got a great group of about 40 people, 6 different offices, 3 different continents, constantly learning new things from them, and hopefully every once in a while teaching them something too.
And then final question, one prediction for the next 12 months.
Other than the Red Sox making the playoffs?
Hopefully the Mets are there with you, and the Yankees are not. So
there you go. Perfect. We can still be friends, Todd.
Yeah, there you go. Well, Mike, I really appreciate you spending a few minutes with me today. So thank you for your time. Continued success to you and the team at Bain, and hopefully we'll get you back sometime in the future.
Sounds good, Todd. Thanks for the time today. Cheers.
Yep. Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.